Everyone, welcome back to Yuri's Box. In this video, I'm going to talk about credit spreads, small caps, and the latest move in treasuries. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So the irony of it all, right? I spent the better part of the last 3 weeks arguing against the squigglies, all right, and how drawing on charts has been, a fool's errand, and you're better off looking at economic data and economic policy. Now, with the move we've had on the 30-year yield, this effectively puts us back at about $85, which, the irony of it all is that we're back at the trend line. All right, now, of course, I'm trying to be lighthearted about what we've been seeing about the move in treasuries and the recent days. But tonight, I just woke up a little while ago and I found treasuries at 5% again. Okay, and why? All right, why would there be the 30-year yield at 5%? As ridiculous as this sounds, as well as looking at the squigglies on the chart, I'm going to say things that might sound ridiculous in hindsight, and I'm fairly okay with taking that risk. This move right here takes me back to training, all right, to the basics, and to when I started out in things like Bitcoin and crypto. All right. Well, not really Bitcoin, rather crypto. And if you spent time in, from 2020 to 2022, you'll remember, and I'm just looking at, this is the altcoin market in general, but if you spent any time in crypto, you'll know that huge wicks up or down can come at a moment's notice. And I remember that, just people would blow up every second, right? And you'd see these huge liquidation wicks. Now, I don't know what is behind this, and arguably, very few people do. I've been reading things like the basis trade, and what the basis trade basically is, I'm keeping things extremely simple because I'm not even an expert on this sort of stuff, but the best way I can explain it is that you're arbitraging between markets, all right? So you're buying a 30-year bond on spot value, and then you're, potentially reselling it on the futures market, all right? And you're making that spread. Potentially, that's kind of blowing up. If you have to read the doomers, it's China that's selling all of its treasuries, and we're gonna, go back to the Stone Age, apparently. But again, if I had to go on instinct and, go back with, what I remember when I started out, which again, this could easily be wrong. I mean, things are evolving in extremely fast fashion. And again, this video could easily be ridiculous in hindsight, but I'm perfectly willing to take that risk, as I said before. This to me reeks of liquidation. And again, I would, for the time being, as I've been saying in my previous videos, I would resist the urge and temptation to listen to the doomers, all right, that this is the end of the world. And again, I go back to crypto because it reminds me of things that I would hear during 2022 that, why would you buy Bitcoin? What if the internet goes away? That was one of the talking points. I don't hear it as often as, I used to. But, things like that, what if the internet goes away? What will happen to Bitcoin? Just think of the consequences of what we're saying. If the internet goes away, the only thing, you're not going to say, oh, what should I buy, Microsoft or Bitcoin? That's not going to be your priority. Your priority is going to be farmable land, All right, a clean source of water and a shotgun to defend it all. All right, so before we give in to the doom posting, I would let things play out. Right then, of course, if she goes on live television and says, you know what, we're dumping everything, game over, then yeah, you can take him at his word. But again, I would resist the urge. And this move on the 30-year yield, again, is something I've been waiting for. Quote unquote, because when I was talking about things like the 06-08 comparison, again, we've seen a fairly nice correlation between the two moves, and they look eerily similar. But of course, something like what we've been seeing overnight, kind of deviates from it. So we finally have the deviation, that I was expecting it to occur. But just to give everyone a level-headed example of why I think it is liquidation and a symptom of stress in the markets, and I think that we need to look through it. And again, this could just be the optimist in me. And again, I could easily be wrong, but I'm willing to take that risk. I'll defer to the 06-08 cycle once again, all right? It's not over. We still have to talk about the 06-08 cycle. And what do I want to point out about this cycle? Well, what if I told you, all right, you don't know anything about the 08, what happened in 08, 06-08. But what if I told you that during 08 we had someone blow up, and that in fact did not lead yields to go lower. In fact, it led yields to go higher. What I'm referring to is Bear Stearns. If you had to just go on instinct, you don't know anything about Bear Stearns. Bear Stearns was basically, they were well involved in issuing bad mortgages, and eventually they blew up. That's kind of the synopsis of it. That's a summary, a spoiler alert for any of you who haven't watched the Big Short. But again, you don't know, if you didn't know when Bear Stearns collapsed, you might think, something that bad, might occur right here, and that leads to a risk off, and people piling into treasuries because, again, it's just risk off. All bets are off. We need to get, the best kind of asset we can. No bankruptcy risk. Treasuries, the long end of the curve. So you might think it happened here. Well, you'd be wrong. You might think maybe this is it right here. This is Bear Stearns, and everyone is, piling into the long end of the curve in extreme panic. Well, you'd be wrong again. Curiously, Bear Stearns occurred exactly here. All right. The collapse of Bear Stearns marked the local bottom for the 30-year yield. In fact, what we saw after the collapse of Bear Stearns, all right, and again, this isn't, a stress-free time. This is an extremely stressful time in financial history. And from the 17th of March, which is the immediate week after, I think Bear Stearns collapsed on something like the 15th or the 16th of March of 2008. After that, the 30-year yield rallied nearly 65 basis points. Right, it sold off, and yields went up by 65 basis points on the 30-year yield. They stayed high, about 54 basis points higher, until August, until a month before Lehman Brothers collapsed. And in fact, this right here is the move that, kind of represents the collapse of Lehman Brothers. That was just game over at this point, No redemption. All right. So again, I would just keep a level head. Go outside, touch grass, look at the sun. Well, don't look at the sun, you'll go blind. But just try to not feed into the doom posting. That's all I'm trying to say. Because if there are huge problems, all right, with the bond market. I go back to the Bitcoin doom posting that I would read in 2022. What if the internet goes away? Well, something incredibly bad has happened, and I'm not thinking about Bitcoin or Microsoft or bonds or Asia or small caps. I'm thinking about something else. I'm thinking about dealing with something incredibly negative. That is the same thing with bonds. I mean, you can't get away with, pushing out, incredibly negative and doomer like scenarios without having to think of what that entails, about the consequences of that. Right. So as long as the price action allows us to keep a level head, I would do exactly that. And I would point towards this being someone, I don't know who, like if you follow Conks on X, I think I if I haven't put it in my favorite accounts, it's one of my favorite accounts. And the reason why I follow Conks is because they talk about the inner plumbings of the financial system, and I don't understand any of it. All right, the only reason I follow Conks is to remind myself of how little I know. But if you follow that account, this very ironic way of pointing out the memes, and like, oh, I'm hearing a pot shop blowing up, or something like that, rumors. And all I can say, all right, is this reeks of someone being forcefully pushed out of, and out of the treasury holdings, forcefully. All right, this again reminds me of crypto days. As ridiculous as that sounds, and it may sound, I know it sounds ridiculous, but to me, that's what it sounds like. That's what it looks like. Someone is in stress. Someone's hurting. And again, by the time I publish this video, it could easily be, overblown. I mean, well, not overblown. It could be easily even worse. But that will be a topic for another video, I guess. So I would just put a lid on the doom posting for the time being, as long as the price action allows us to keep a level head. So that's treasuries out of the way. If the risk-free rate, right, is suffering, where does that leave junk debt and really low-rated corporate debt? My wager would be that this is the start, right? If we've seen something of this magnitude occur in the bond market, in treasury market, I wouldn't be surprised if by Friday we're well above 5%, 5% spread, and potentially knocking on the door of 6 and 7. Or I don't even know, but it doesn't have to be by Friday, all right? I don't know. But if this kind of move is occurring, and it is stress in the system, I would imagine that the immediate consequence is credit spreads continue to move up. And it is, in fact, what you would call a credit event, a liquidity event, with everything that entails. And that goes back to something that I spoke about, well before the tariffs, where you had this kind of divergence. And again, this is an original thesis. I mean, this has been well spoken about by a lot of people. If you're an X, the most outspoken person you can read is Michael Guyard. He's been talking about this forever. It's been 2 years that he's been talking about this divergence. In any case, the divergence I spoke about in my previous videos is that credit spreads being this low right here cannot coexist with the Russell 2000 underperforming on a relative basis. Because yes, from the lows of 2023, you might say, yes, hooray, we're up 50%. Just like the S&P 500. But we're not even barely, we just matched the 2021 high, all right? That is basically going sideways. That is doing nothing. That is the definition of doing nothing over 4 years, all right? Nearly 4 years at this point. So one of one of the two only one of the two can be right. Pardon me. Either the stocks or the small caps. So because why is the parallel between credit spreads and small caps? Because triple B rated companies and corporations are usually companies that are potentially over leveraged, that they have trouble financing, and that usually fits very well with a small cap, imagine, all right? So you take the small caps as a proxy for the stocks of the companies that are trying to get financing, all right, via triple B rated debt. So again, only one of the two could be correct. If small caps are correct and underperforming ever since 2021, then credit spreads had no business being right here. If credit spreads were correct and being right down here, then you would have expected to see small caps outperform and be well over 3,000, for example. Because what a low credit spread tells you is that there is low bankruptcy risk. Well, low perceived risk. All right, the perceived bankruptcy risk is low. All right, so if bankruptcy risk is low, then why wouldn't the stocks of those companies outperform? All right, that's kind of the idea. So what we're seeing right now is really a breakdown in small caps. Well, we've been actually witnessing it ever since 2024, November of 2024, ironically. From the bottom, we consider top to bottom, we're down 31%. That is, well beyond bear market territory. And I would expect this mechanic to continue to play out. How low could small caps go? I wouldn't be surprised if it's actually, if I had to put on my squiggly chart, given the fact that we just had the long-awaited retest of the trend line. If I had to put my squiggly line goggles on, I would say right here. I wouldn't be surprised if this is actually where small caps end up bottoming out. But that's just me putting on my squiggly line goggles, and it doesn't mean anything, absolutely anything. So again, as I said in my video last night before I went to bed, watch credit spreads. I think that this is where the next part of the chapter is going to unfold, and potentially it already is unfolding right in front of our eyes. And again, I think that this will lead us into the next chapter. And the next chapter is the consequences of credit spreads blowing out. And the consequence of credit spreads blowing out is that small cap companies really, the backbone of the American economy, as they say, as politicians say, and on TV over and over again, they're in trouble. And I'll make another video on this topic, and I'll cut this video short, as short as this video is getting. It's 20 minutes already, but the direct consequence I would point towards is unemployment rate going up, because companies are going to have more trouble staying in business because they're not going to be able to refinance or get a hand if they're in trouble because of the fact that there is increased bankruptcy risk being perceived in the system. And so that is going to lead to increased bankruptcies. And arguably, bankruptcies in the last few months have been the highest they've been, if I'm not mistaken, ever since 2008. So some of the things that I pointed out before the tariff drama still hold, in my opinion. I do believe that, Trump's tariffs were definitely like, call it the straw that broke the camel's back. But I do believe that overall, there were already signs of stress in the economy. And you can look at it, I've been pointing these things out well before, the Trump tariffs, and, many people before I started making videos. You can look at the quits rate for that. I like to look at the quits rate. You can look at the fact that, again, continuing claims have continued to be stubbornly, high, on relative terms. Bankruptcy risks, bankruptcies have gone up. And if you go and look at the non-farm payroll report, I always say, and I always make sure that I say that at the headline level, things look okay. Because if you go and look deeper, things like the household part of the survey, they're not that great, all right? And if you go and look at the jobs that have been added, it's mainly healthcare and education and government, as of, a few months ago. That is typically not a good sign. Whenever you see the bulk of job gains coming from those sectors, that's not a sign of a healthy economy, right? You want to see broad-based job creation across all sectors. When it's only healthcare and education, something's fishy, something's wrong. All right, so I do believe that there were issues well before, and I did my best to highlight them before the Trump tariff drama. And I think that this is just, the ignition. All right. So, moral of the story is try not to read too much doom posting. I would defer, again, to the trusty 06-08 cycle. Look at what happened during Bear Stearns and imagine. That's what you have to do. Imagine looking at Bear Stearns collapsing and saying, of course, Bear Stearns is collapsing. Everybody's going to pile in to risk-off assets. Because it's, a sign of a bad sign, an incredibly bad sign. But instead, you see the exact opposite reaction. You see stress in the system and potentially people having to liquidate, what they can. And usually that's bonds. All right. So, again, I would keep an eye on everything. If Xi Jinping comes out on live TV and he says that, what's up, Beijing? We're dumping treasuries. Then, take him at his word, and you can actually give in to some of the doom posting. But until he goes on Bloomberg and, gets interviewed by Jonathan Ferro and Lisa Abramowitz on why he's dumping treasuries, I would try to keep a level head as much as possible. All right. So, if you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. Again, thank you to everyone that has subscribed, commented, and I'm incredibly grateful. I'm really humbled by how you've been helped me to grow the channel in such a short period of time. I only started in February, and here we are at well over 75 subscribers last time I checked. So thank you, and I'll see you next time. Bye.